Ben McMillan is a founding partner and CIO at IDX Advisors. Ben, what'd you learn this week?
Well, I mean, I think it's been an interesting week. I think the biggest standout to me, aside from kind of all the obvious stuff with the CPI prints and things like that, I think Powell's messaging on Monday coming into this week, I was very focused on Powell's messaging this week. And, it was interesting that he said we've shown some modest further progress. The fact that he used the word modest, he's definitely messaging that, one good week of data doesn't necessarily make a trend. It's headed in the right direction, but, inflation is going to be a bumpy path. So I think market discounting, rate cuts in September, potentially again in December, is probably about right. I think it'd be excessive to discount, 3 rate cuts. The other thing that stood out to me this week was the kind of the broadening out of the equity market, which we've seen, which I think is good. It's been, very concentrated in the Mag 7 for pretty much all this year. And, the bid that we've seen, kind of the sustained bid we've seen in small caps, I think is very encouraging for, equity markets in general. So I think it was a good week. There's still a lot of wood to chop, but it wasn't bad.
Yeah. I like the point about Powell's terminology there, because it's exactly the same takeaway I had, that doesn't sound like a man ready to cut. And usually he's pretty face up when he's getting to that direction. It's not a big mystery when his language turns. And it seems reasonable because, he's got Jackson Hole in August, but no meetings. So it seems like he should kind of still leave some optionality on the table. And we've got a good chunk of calendar ahead of us before September.
Well, exactly. So we've got, earnings season, coming, and we're just getting into that. So there's going to be all eyes on earnings now, especially for the equity markets, because, listen, things are looking good, but valuations are still high. So, there still needs to be good data coming in off the back of earnings. And, one thing we've been saying from the beginning of this year is keep an eye on the consumer, keep an eye on the unemployment rate, because, that's when, historically when rates have been cut, the question is, well, why are you cutting rates, right? And Powell has signaled this all year is, we have to see, excessive, weakness in the labor market. And, the labor numbers are definitely softening. And if you look under the hood, there's a lot of yellow flags there. And so, again, to your exact point, last thing I'll say too is the yield curve is starting to de-invert. And again, historically, it's not the yield curve inversion that has been the catalyst for recessions. It's when it, de-inverts. And that's the period that we're at right now. So, the Fed is definitely trying to thread a needle as it relates to the soft landing. I think it's all eyes on earnings, all eyes on the consumer. And, if we continue to see this kind of broadening out of the equities market, I think that actually bodes well going into the back half of this year.
Okay. What type of data do we need to support that broadening now? Do we need to see the creep in unemployment stop? Do we need to just see earnings bottom out? What will kind of justify this move here?
I think it's, it's really small caps. That's what you want to see. When you look at kind of the delta between small caps and large caps, it's, it's at historic, historic levels. And so, obviously, declining interest rates or declining rates are generally good for small cap companies. Those are the companies that don't have the big balance sheets, that don't have the access to capital. And let's also not forget, the majority of the U.S. economy is driven by, small to mid-sized companies. And so just for, general health of the U.S., the U.S. economy, you want to see strength there. So, I think you'd want to see equity investors are going to want to see, good earnings, but also kind of good messaging going forward. We've had a couple of this year, there's been some kind of notable earnings where, Walmart comes to mind, where they've talked about, they're seeing higher end consumers starting to shop at Walmarts, and, things that we associate with kind of the 2008 era of potential recession. And so, it's definitely earnings are going to matter. I think sustained strength in small to mid-sized companies is going to matter. And then again, unemployment, that's something you don't want to see, go off the rails. And last thing I'd say as it relates to that, one thing we've kept a close eye on all year is, charge-offs. There's a lot of debt out there, not just public debt, but private debt. And, we're seeing, bankruptcies elevated. We're seeing charged off consumer debt elevated, auto debt. And that's something that doesn't get a lot of headlines. But again, the consumer is the driver of the U.S. economy. And, for this to continue chugging along, the consumer needs to be in good shape. And so that's why unemployment, charge-offs, debt matters a lot.
Who do you watch for charge-offs? Capital One, Discover?
Oh, I mean, all of them. You know, credit card debt is an important canary in the coal mine. You know, years ago in another life, I was a quant at American Express, and you know, we would see it in the data. You know, before everything is you know, Americans love their credit card debt, and so when they start, you know, writing off en masse, that's something you want to keep a look at. Auto too. So I would say that's the canary in the coal mine to look at is you know, the under the hood of the unemployment numbers, the charge-off numbers, and then again, you know, hopefully earnings continue to, you know, come in, you know, at least relatively strong across the spectrum, not just mega cap tech. And like I said, you know, Fed's got its work cut out for it. You know, but so far so good.
All right, good stuff. Good analysis, good assessment, Ben. Thanks for the commentary.